afternoon, ladies and gentlemen. I'd like to wish you a very warm welcome to the 4th Annual General Meeting of Smithson Investment Trust plc, which I now declare open. I am Diana Dyer-Bartlett. I'm the chairman of your company, and with me are my fellow directors. I have Denise Hadgill, Lord St John of Bletsoe, and Jeremy Attard-Monchet. So I confirm that the meeting has been properly convened and a quorum of shareholders is present. In accordance with the company's articles, I will act as chairman of the meeting and represent the proxy votes that have been submitted in advance. The format for the proceedings today is that we will start with a presentation from our investment manager, Simon Barnard, who's accompanied by Will Morgan. And this presentation will be filmed and made available on the company's website after the meeting. So I will now invite Simon to address the meeting.
Hello everyone, and thanks for joining us. I'm Simon Barnard, manager of the Smithson Investment Trust. I'm going to take you through last year's performance, the year 2022. I'm going to take you through what we did during that year and portfolio adjustments that we are making and look to make in the future. So let's start with performance. 2022 performance was very poor and we are extremely disappointed by it. This, we feel, had a couple of different elements to it, which we will go through in some detail. But ultimately, you can see the numbers here with 2022 down 28% for the NAV, the share price down 35%, and the reference index, the MSCI World SMID Index, down around 9%. Now, actually, it was a very poor year, but in reality, an extremely bad 6 months, because actually in the second half of the year, the trust was up in absolute terms. And so it just goes to show in some cases that market performance can well be like sitting in the dentist chair. You sit there wondering how bad it's going to get until suddenly you realize, hopefully, it's already over. And we can say that performance has continued to improve year to date. We've put the first quarter 2023 here on the far left, with the NAV up nearly 9%, the share price up 5%, while the reference index was up 1.6%. But even though it was only a 6-month period, of course, that means it was extremely volatile, and this volatility has become unacceptable to us. So for that reason, we are very focused on reducing that volatility going forward. So you can expect to perhaps see either an increase in positions in the portfolio or a slight change of composition of the portfolio. But be assured, we are very focused on reducing this volatility in the future. But that, of course, does not mean that anything else has changed. We still have an ambition to generate at least double-digit returns over the long term. And you can see, even after such a terrible year, the annualized return since inception is still slightly over 10%. And you can also be assured that the strategy will not be changing. So it will still be the same quality companies with the growth that we seek to own for the long term. So moving on to what actually happened in 2022. As you can imagine, we have spent a lot of time going into a very deep post-mortem on the occurrences during the year. And really, from our perspective, there are two major elements to the underperformance. One, of course, was a significant macroeconomic headwind, but the other was the fact that we did make some mistakes, and we will go through that as well. First, though, on the macroeconomic front, you can see here we've put key issues affecting the stock market. We will all know them, they're quite familiar. Of course, inflation, which really began in earnest early in 2021, leading to rising interest rate expectations by market participants, obviously followed by actual interest rate increases. And then finally, fears of recession, which were brought on by these higher interest rates and now worsening labour data in several markets. And to illustrate the overall effect that these had on the market, we have put in the center of this slide a table showing in one column the performance of the MSCI World SMID Cap sectors, and in the second column the weight of our holdings in each of those sectors. And you can see by the green and red bars that there were very few sectors globally which actually were up in absolute terms during the course of 2022. Those primarily were energy and utilities, neither of which we owned any stocks in. And actually, I should say, we are very unlikely to ever own any stocks in, primarily because we do not believe in owning companies which depend on either commodity prices or regulation. However, on the flip side, we did own a lot of companies in poorly performing sectors such as information technology and consumer discretionary. So this is only put here to highlight the fact that there were some significant economic headwinds to the performance of this type of strategy. But I said we made mistakes, and I think there were several. Primarily, we believe that we held on to some companies that were expensive at the end of 2021 through the course of 2022, obviously exacerbating the poor performance. Now we have reflected on why that happened and actually have adjusted slightly our valuation process, not the metrics that we focus on, which have always been and will always be free cash flow, but in some ways the limits that we focus on. And so we hope, and actually there have already been some practical changes around this point, we hope that that will prevent us, or at least reduce the probability of making the same mistake in the future. And the second is that clearly there were some companies that did do well in 2022, which we might have owned, which still did fit our performance and quality criteria. But I have to be honest, there were very few. In fact, in our investable universe, which many will recall is the long list of names from which we draw the stocks that we want to make up the portfolio, within that long list, there were only a small handful of names that were up in absolute terms that we could have owned, but we could have owned them. And so we, again, have reflected on this and decided to increase our focus on the research of new companies so that we, at any one time now, will be researching more new companies than we had done previously. So just to end this slide with looking at the actual contributors and detractors to the portfolio for 2022, which you can see on the right-hand side of this slide. I won't focus too much on the contributors because there are only a handful and they weren't particularly meaningful, but on the detractors, I believe is a lot more interesting to focus. Fever Tree Drinks was our worst performing stock in the year. This actually was due to fundamental issues where the inflation on their cost base was such, particularly around the production of glass and tin, as well as logistics, because up until very recently, Fever Tree shipped a lot of product from Europe across to what is now quite a fast-growing market in the US. So as logistics prices ballooned during COVID and beyond, they suffered greatly on that cost base. And a combination with the fact that they decided not to increase prices in their fastest growing market, which is the US, and rather accept much lower margins, which meant that their gross margin fell from around 50% a couple of years ago to now well below 40% as the cost inflation hit. The reason we hold on to this company still is twofold, really. They continue to grow well, which we are impressed by and believe will continue into the medium term. But also, we see that this is a shorter term issue on cost and margin. In fact, we are already seeing their cost inflation abating. Management tell us that while this is very good news, obviously, it may not reflect necessarily in their P&L until 2024 because of the hedge contracts they have in place, but still it will be an almost direct pass-through into their margin as time goes on. And then finally, they have decided to increase price somewhat in the US, which they'd been hesitant to do because they'd been growing so fast. They didn't want to disrupt the momentum in that market. But now they see the majority of the market as such, or their position in it, as such that they are able to slowly start increasing price, which will again alleviate the pressure on margins. So we feel that that is a situation that should resolve itself over the next couple of years. The second company I'd focus on is Temenos. This is a Swiss software company which sells core operating software to banks. They too have had a couple of issues. The primary one is that they have been transitioning their business from the sale of long-term perpetual licenses to shorter term or long-term contracts, but shorter term payments of software as a service or as a subscription, otherwise known as SaaS. So as they go through this transition, their P&L can look quite different because the large upfront payments for perpetual licenses are replaced by smaller monthly payments for software as a service payments, which obviously can throw off the growth rates that appear to be occurring. Underlying the structure of the business is relatively unchanged, and in some ways it is a very positive development because it has been shown that those customers on longer term software as a service contracts actually prove more valuable over time. However, we do feel that while many software companies are going through this process, it has actually been particularly badly handled by Temenos. And so actually we weren't too upset when the CEO of Temenos was fired ultimately at the start of this year, and they are searching for a new one. So that again has shown a degree of progress at that company, but certainly it is one that we are very closely following. Moving on to the exposure breakdown. This has changed somewhat since the start of 2022. We're showing you the exposures here as of the end of March of this year, although there has not been much change since the end of last year. But therefore, just to highlight the changes across the course of 2022, you can see that information technology now 34% weighting, actually used to be at 44% weighting at the start of 2022. So that has reduced materially. That is partly because we exited a position in a software company, and partly due to the underperformance of technology during the course of the year. Industrials, on the other hand, increased because we added a couple of names, which we will touch on later. And healthcare also increased thanks to a topping up of some positions in the portfolio. Finally, consumer discretionary was increased by 5 percentage points as we added a name in that space. Then moving on to the country weightings. This is the center of the slide, which shows the country of listing. The US, which remains our number one geography for country of listing at 40%, actually is down again somewhat, 7%. We sold 3 companies last year, which we'll go through, and all of them were listed in the US, so that is the main reason for that. The only other major movement to note is Italy, where an addition to the portfolio took that up by close to 6 percentage points. However, the exposure that really makes the most difference is the sales exposure by region. This is where our companies are actually generating their revenue from. And actually, this hasn't moved that much despite the changes in the portfolio. Europe is number one with 39%. That is actually only up about 1 percentage point. And North America, which used to be roughly equal to Europe, is down slightly because of those sales that I mentioned a moment ago. So the strategy, this has not changed at all, and it will not change. However, we are focused on making adjustments to the portfolio. We remain in our attempts to buy good companies, to try not to overpay for those companies, and then finally to do nothing. But to start with the buy good companies, we believe that we still do own very good companies despite what the share prices may have done in 2022. This is a look-through table, as we call it, highlighting the aggregation of the operating metrics of all of the companies in the portfolio as of the end of 2022. And you can see our primary shorthand measure of quality, return on invested capital, is on average 43% for the companies in the portfolio. We think this is a very strong number. And actually, you can see that by comparing it to the MSCI SMID index, which has the average at 11%. Gross margin, we find this is very important for companies in the portfolio. A gross margin of 65% means that our companies produce their goods for 35 and sell them at a price of 100. This is clearly a high margin and beneficial to our companies in periods of inflation. If you can imagine a company which instead had a 50% gross margin, that means that they produce their goods for 5 and sell them for 10 or 50 and 100. And so for us, our companies, if you see an inflation of 10%, they only have to deal with a 3.5 increase on their 35, whereas those other companies would have to deal with a 5 increase on their 50. So you can see that it's not only easier to mitigate those higher costs, but in some cases easier to increase prices to offset them. That, of course, leads to a strong operating profit margin of 25%, again, far in excess of the index average, and cash conversion, which is 100% for our companies. That is actually quite a low number for what we have seen historically. And interestingly, over the course of 2022, that cash conversion came down as a lot of our companies rebuilt working capital, which they had run down over the course of the pandemic when there would have been those highly publicized supply chain issues. As those supply chains started working themselves out throughout 2022, our companies discovered that they could rebuild inventories, and that led to an expenditure of cash and the overall cash conversion of the business falling for that year. But we, again, don't believe this is necessarily a long-term issue, one more constrained to last year. And then finally, we put interest cover here simply because on average, our companies are net cash and don't have debt. We do have some companies with debt, but on average, they are net cash. Now, as part of the buying good companies, we thought we would include this year a slide on ESG and how we think about it and how that feeds into our definition of good companies. Because of course, good companies who are able to sustain high returns on invested capital over time will, of course, be very focused on ESG themselves. And so these ESG considerations start at the very beginning of our research process when we are looking at new companies to potentially put into the IU and subsequently the portfolio. But as we think about the different aspects of ESG, starting with environmental, we realize that our approach, where ultimately the sectors that we are focused on include information technology, consumer, and healthcare, naturally avoid high polluting industries and companies. And to put this into numbers, the average greenhouse gas emissions for the companies in Smithson are around 27,000 tonnes a year versus the MSCI World at 4.5 million tonnes a year. But of course, that's slightly unfair because we're looking at smaller mid-cap companies. So on a basis of a per £1 million of free cash flow, our companies emit 99 tonnes per £1 million of free cash flow per year versus the MSCI World at 365 tonnes, so still 3 times more. We also, though, own companies that not only are not emitting, but are actually trying to help other companies reduce their emissions as well. One example of this is Spirax-Sarco, which produces steam traps and equipment for any companies and industries using steam in their processes, which are the majority. But they are also, by enabling this companies to use their equipment and redesign their processes, clearly saving energy. But they are also expanding now into heating water via electrical means. So all of the steam process are burned or are generated using electricity rather than burning gas, which again reduces direct emissions for the companies using their services. And then on the flip side, we have some companies that could do better on the environmental side. One of these is Ambu, and this is where we give examples of companies that we've actually engaged with to understand and encourage to potentially improve their environmental credentials. Ambu is the designer and producer of disposable endoscopes, which by their nature being disposable, one might think that they are always thrown away at the end, which would be incredibly wasteful and impactful. But actually, over time, they are increasingly able to recycle the components of those disposable endoscopes, and it's something that we are closely monitoring with the company. Then, moving to social, really we are focused on the company's work environment having happy and successful employees, because clearly that is a primary step to a successful business. One statistic that we have for our companies is that women make up 29% of portfolio company boards, and that is an improvement from 21% in 2018. Clearly, it is not where we would like it. We would like it to be higher. But in comparison to the MCI world, at 28%, it is very slightly better. Companies helping in the social sphere include Halma, which we own, and this is providing equipment for safety in the workplace. And one company that we are engaging with on this topic is Domino's Pizza, primarily because you must bear in mind that the vast majority of Domino's Pizza workers are clearly low paid, and there is always a threat within that type of environment for abuses of employees. And so, bearing in mind that Domino's Pizza don't directly employ those employees, as they are all done via the franchise model, it is important that we understand, that they understand how well the franchisees are treating their employees and all the safeguards that are being put in place for those employees, not only to make sure that the minimum levels of national pay are met, but also around topics of modern slavery. And then finally, on governance, this is potentially the area where we are most active engaging with our companies. We actually voted against the remuneration at 24% of AGMs over the last 12 months. One example of a company that is helping is Fortinet. This is a US cybersecurity company. Obviously, its entire business is devoted to protecting the integrity of corporates. But one in which we are still engaging with is Temenos. I mentioned earlier, we felt that its transition to a SaaS-based model was not well managed. We felt the CEO at the time was out of his depth. He has now been changed, and they are searching for a new CEO. So we continue to engage to make sure that that corporate structure is appropriate. Bearing in mind also one issue we had was that the chairman was an executive chairman. So he was getting heavily involved with the day-to-day running of the company. We felt there was not enough separation between the supervisory board and the executive branch. So we, again, is something that the company is looking to change under the new management. The second part of the strategy, don't overpay. This has been not particularly straightforward, as we've outlined last year, but what we think now is that looking at the overall valuation of the portfolio, you can see the far right column as of the end of 2022, the Smithson Investment Trust is now trading on a free cash flow yield of 3.3% relative to the reference index at 3.5%. And we are happy with that slight premium. If you look throughout the history since inception, our shares have always traded at a roughly 10% premium to the index, which we believe is fair given the much higher quality of the companies in the portfolio. The only other thing I'd point out is if you look back at the time close to our inception of December 2018, where the trust was trading at 3.9% free cash flow yield, I would just highlight that actually we are back to very similar levels today. Over the course of that period, the portfolio has changed in its composition, so that if we were to take today's owned shares back to 2018, they would again be trading at 3.3%. And on the other hand, if you took the original portfolio from 2018 forward to today, they again would be trading at 3.9%. So either way you look at it, we are roughly back to valuation levels of 2018. So that is not to say necessarily that everything is extremely cheap today. I don't think we can say that, but it's certainly not expensive as it appeared to be at the end of 2021. And then finally, just to look at what we actually did during the course of 2022, and we've also put here for context what we were doing before that, you can see that we added 3 companies to the portfolio. That includes Moncler, the Italian fashion branded goods company, Adtech, which is a Swedish industrial company distributing industrial products, much like Diploma, which is another company based in the UK that we already own, and IDEX, which is an industrial company producing items across many different divisions, including fluidometers, fire and safety, and health and science. And to fund that, we sold 3 companies, one including A.O. Smith. This is a US water heater and boiler manufacturer. Actually, we sold very early on in 2022. This was one of our most cyclical companies at the time of ownership. And of course, in the beginning of that year, we were already starting to grow concerned about rising interest rates and fears of recession. And so this being our most cyclical name, we decided to sell very early on, given we were still getting an attractive valuation for it. Wingstop, which was a US chicken franchise restaurant, this had a couple of red flags. Primarily, its long-term CEO, who had been credited with much of the growth of the business, suddenly announced his departure for another opportunity. That made us quite concerned. And then second, the management started discussing investing in their supply chain, which of course for a chicken restaurant means chicken farms. That is not something that we set out to own when we bought this company. And so for those 2 reasons, combined with actually quite a hefty valuation when we sold it towards the end of the year, we decided to exit that position. And then finally, Ansys. This is a company which over the last few years, it is a US software company, had been making quite expensive acquisitions. To put it into perspective, for the 3 years before we bought this company, they had on average spent $29 million a year on acquisitions. In the 3 years after we owned it, they spent on average £600 million a year on acquisitions, many of which had very little revenue and certainly no profit. So we could track as time went on that return on invested capital for the overall business declining, such that when we acquired it, it was on around a 30% ROIC. By the time we sold it, it was just under 10%. So we had often engaged with the company on this point and basically realized that we were banging our heads against the wall. And so we voted with our feet on that one. And then finally, we have acquired a new position in the first quarter of this year. We are still finishing up a position. In fact, we've just finished. So we will be announcing the name of that position at the end of this month. All of that activity plus adjustments within the portfolio of topping up certain companies which we strongly believed in but had very difficult share price movements during the year meant that our overall voluntary turnover was 48%, far higher than we had seen in any other given year. But you will notice that in periods of volatile markets, we will set out to try to take advantage of those volatile price to make adjustments in the portfolio. And you can see that in 2020, also during a volatile period, our turnover went up markedly. And then finally, to touch on the buyback program. So in the course of the year, there were both shares issued and bought back. 5.4 million shares were issued, but 5.7 million shares were bought back. That buyback program continues. The board are obviously here to discuss that should you wish. But I think as long as that discount is maintained at a substantial level, the board have informed us that the buyback will continue.
That concludes the formal business of the meeting. Thank you very much for attending, and I'd now like to invite you to join the board and the investment manager for refreshments. Thank you.